Hello, everybody. Welcome. And we are Ben, Joe, and Matt, members of the team here at Baldwin Management. We are happy to be presenting this second episode of our six-part series about the retirement crisis. Our first episode is available on our company website and our YouTube channel. If you're joining us live today, we encourage you to check that first episode out if you have not already. And if you are watching this after the fact, we just encourage you to start with that first episode and watch the episodes in order. We built and titled this episode based on our approach to taking the long-term strategy building that should be part of retirement planning. We're going to approach retirement as a journey and present this today. It's kind of three different stages of life, giving an introduction to the priorities, tools, and strategies that change along the way. So the first chapter that we're going to be talking about is going to be your 20s and 30s, where you're simply learning the basics of life and your career and where everything goes. After you've left the nest. Chapter 2 is going to be when you're in your 40s and 50s. This is where we're going to focus on the introduction to making course corrections. And then our last chapter is going to be when you're 60 and over, and you're coming into port from your career journey and getting ready for the latter part of your life. So Joe and Matt, could you please start things off with just some background and some of the reasons why we're excited about this and why we're using this approach today?
Absolutely. Thanks. And hello, everyone, whether you're watching live or pre-recorded, thanks for joining us. I guess the best place to start is, in our first webinar, we talked about the retirement crisis, recognizing that it is, how it could affect every individual, regardless of their age. In this one, we're going to get a little bit more into the nitty gritty of the specific accounts that you might encounter along your journey from your career to retirement. So first and foremost, it's not that most people don't fail to save. What we run into a lot is that they fail to save because they're saving they fail because they're saving in the wrong place. Just to give you a brief example, somebody in their 20s who's contributing, let's say $5,000 to a traditional 401k and or IRA might exist in the 20% tax bracket. Something like that is going to save them $1,000 in taxes today. But if we were to then put that money in a Roth account instead and pay the taxes up front, the decades of growth could turn that $5,000 into over $300,000 in tax-free retirement dollars.
So I think, Joe, you bring up a lot of good points. Also, we should really start talking about this conversation with people before they're just doing their tax returns annually each year. This should be kind of about optimizing throughout the year and throughout the years over time. And it's not really about perfection right at the start. Really, it's about just rough optimization, kind of growing it over time, progressing into, maybe higher savings rates and maybe different kinds of accounts, certainly for the different tax buckets. But the point kind of remains simple. It's not necessarily just about saving more over time. It's about saving in the right account at the right time with the right strategy kind of going forward.
Yeah, absolutely agree. And during our conversation today, we're going to mention a lot of terms, like a lot of names for different types of accounts. And I'm sure that a majority of you are familiar with them, but some of you may not. But we wanted to, before we begin, kind of do an overview of all the accounts that we might mention today. This is not an exhaustive list, but these are the ones that we typically run into when dealing with clients. So we'll start with just the standard brokerage account, a non-retirement account that allows you to put money in and invest in a wide variety of investments, be they stocks, ETFs, mutual funds, or anything else. These dollars typically are going to go in, after tax, and they're going to grow according to how they're invested and how the market performs. And when that money is withdrawn, it's either going to be taxed at a short or long-term capital gain rate, which usually is going to be a little bit lower than what your income level your income tax bracket is. Next, we'll look at some options that are available to everybody. We'll keep it in that same universe with the traditional and the Roth IRAs. Individual retirement accounts, right in the name, allows you to either put pre-tax or get a tax benefit at the end of the year in terms of the traditional IRA, and the money grows tax deferred, meaning that when you take it out, it's going to be taxed at your income level, or a Roth IRA, which you get no upfront tax benefit from, but the money that you put in, the funds you put in, are allowed to grow tax-free, provided you wait a certain amount of time. That money can be withdrawn, and the earnings can be withdrawn free of taxation. Now, from an employee or employer standpoint, there's a slew of different options, and I'm sure depending upon where you work, you might have heard terms like 401k, 403b, 457b. These, for all intents and purposes, for our discussions today, will kind of be treated interchangeably, even though there are subtle differences to them. They essentially look to accomplish the same thing. These are retirement plans offered by your employer, not necessarily required, but typically an option, especially amongst larger employees or employers, that allow you to contribute, much like the traditional and the Roth IRA, either pre-tax dollars or after-tax dollars into them. And they're going to follow a lot of the same rules in that if it's traditional, you get the tax benefit up front, earnings when they're withdrawn, provided you wait until the age 59 and a half when you take them out penalty free. They're treated as income. Roth, earnings grow tax free, take it out, and it acts just like a Roth. Usually with 401ks, both traditional and Roth, you're going to be limited to about 20 to 30 mutual funds specifically. Unless you work for a large public company, there might be an option to invest in an employer stock, sometimes at a discount. But usually what we see is just a list of mutual funds that have been pre-selected by the HR or finance department of that company. Another, maybe a little bit lesser known, is the simple IRA. And typically these are going to be meant for employers of less than 100 people. And generally, they require the employers to provide either matching contributions up to a certain percentage, provided that the employee is also making contributions, or they can elect for a flat all-catching contribution, meaning that even if you elect not to put money into your retirement account, your simple, the employer is still required to put a certain amount in. They're going to function in terms of their earnings and tax treatments. They can be both Roth and traditional, but it being an IRA, it's going to offer far more investment options than what a traditional 401k or 403b, 457d are going to offer. You're not usually limited to mutual funds. You can invest in individual stocks, ETFs, and mutual funds that exist within the entire market universe. Matt, I think we'll jump on.
Joe, before we jump into Matt, could you just introduce, just address how or where different types of retirement accounts may be limited when you have different, if you have a 401k, is there any kind of limitation that goes into play with, say, an IRA? We had a question come in. If you could just quickly, just of those big types of accounts, just a quick, are there any limitations? Are they affected by anything? What does that look like?
Yeah, so traditional and Roth IRAs, the individual retirement accounts, they're going to have a contribution limit on a year-over-year basis that is going to be based upon, that's going to be much lower than what you're typically going to see in a 401k, 403, 457. Additionally, Roths are going to have the added restriction of an income limit. Now, there are possible ways around that, such as backdoor Roth conversions. But in general, if your income, either filing single, filing jointly, is above a certain number, you are barred in a certain sense from contributing to like a Roth IRA. That tends to be a little bit different on the 401k side. Those limits are much higher in terms of what you're allowed to contribute. And the simple falls somewhere in between the two of them. You got traditional regular IRA accounts. We're going to allow the smallest amount that can be contributed on a year-over-year basis. 401ks offering the most, and the simple falling in between those two.
So conclusion with all of the details, it's important to come to that situation, having a question about what is the best way and where should I contribute. You want to have two basic questions answered at the start is, what is my income and how much free cash do I have to make contributions to retirement accounts?
Correct.
And those are definitely very personalized answers to be given to those questions. And so that's definitely worth having a conversation with those specific details in mind to help make those decisions. So I think, we talked about those. Let's just quickly introduce just the other types of accounts that we want to have in people's heads. Matt, if you want to jump into those before we go in and embark on the chapter 1 of the journey.
No, certainly. Just a few other ones we have kind of in mind. HSAs, health savings accounts. These are pretty powerful accounts, especially for qualified medical expenses. Ultimately, this money can go in tax-free. It can grow through investments tax-free. And then if the distributions taken out are for these qualified medical expenses, then it is tax-free on the back end. So definitely a way the government wants, and employers certainly have options for their employees to be able to contribute in, pay for medical expenses. And it's just kind of a little bit of a help over the years, and they can grow certainly pretty large. And if they're not touched for a long time, it definitely is something to rely on maybe in retirement for just for medical expenses. Also, just a few other smaller options for small business owners, an SEP, a SEP IRA. These are available to business owners. They can make contributions based upon their net income, and a small little calculation that goes with that. It's roughly about 25% of net income up to a certain annual cap. These can be traditional or Roth in nature, but definitely powerful tools for small business owners. There's also a solo 401k. This is only available to employee owners and their spouses potentially. The business owner can make contributions in on both kind of the employee and employer side to kind of max out the amount of money they can put into the specific retirement account. But these are just a couple small business owner options that are out there. But Ben, if you want to take us into our journey beginning on step 1, phase 1 here.
Yeah. So phase 1, early career, 20s and 30s, either graduate from high school, graduated from college, leaving the nest. We want to focus on this proverb from the Tao Te Ching with a journey of 1,000 miles begins with a single step. And to prepare for a conversation today, we put together a step 1 for everybody. Simply put, do not panic. Getting to retirement is all about strategic planning, but that planning can feel overwhelming, especially if you try to do it all at once. We've used some of the phrases, some of the words, some of the background, nuances of 401ks, IRAs. We'll talk about backdoor Roth conversions, SEPs, RMDs, QCDs. All of these things can sound like a foreign language the first time you're hearing them. We want to emphasize that at the early part of your career, learning is the best step 1. It's not to panic. It's learning. Find out what's going on. Find out what's available. 2 years from now, from us recording this webinar, the options could be completely different. The options were different for people at the beginning of their careers. A couple decades ago, a couple years ago, they were different. So the key is to learn the options that are out there. It's not building a brilliant decade-spanning legacy-building strategy from the start. We want to focus on avoiding unforced errors. Also focusing on setting good habits and laying a foundation to be able to take advantage of long-term strategies as they become available. I think now would be a good time to talk about some of those long-term strategies.
Yeah, Ben, you mentioned it when you're just starting out, be it out of high school or college. You don't need to necessarily have your entire life mapped out from a financial perspective. Things are going to change dramatically as you get older. Different priorities will arise. What we typically see, though, when you're starting out, and again, it's not going to be everybody's situation, but normally your income is generally lower. You've gotten your first job, you've broken into an industry that you either went to school for, and with that, your tax planning tends to be a little bit more on the simple side. It's still very important, but it's usually not this big, complicated process. When I say when you exist in a lower income bucket, as I mentioned earlier, you can start to take advantage of some of those accounts that I mentioned, the Roth accounts. Now, again, everybody's going to be a little bit different in terms of how much they're making, whether or not they qualify to be able to do Roth IRA contributions. But usually at this point in time, when you're just starting out, you've got the advantage of a long career still in front of you. And any way that you can make contributions and take advantage of these retirement accounts, what we usually see is people taking advantage of either Roth IRAs, the Roth component of 401ks or simples if they're offered by your employers, just to get started. And to kind of put a little more context behind that, as you said, Ben, there's a bunch of information and you can try to plan it out. Some very basic things that we tell people. If you are fortunate enough to work for a company that has some type of employee retirement plan, and they are giving some type of benefit, either they're giving a matching contribution, at the very least, we would recommend, if you can, contributing up to that amount that you are matched on, because if you don't, we're just leaving money on the table at that point. Additionally, retirement is a very, very long way away at this point, but we might, if you have the disposable income, we also look, we don't necessarily want to just throw everything into retirement accounts, because they come with restrictions on when you can pull the money out. If you can, we also start building up the standard brokerage accounts that I mentioned earlier. So we can still take advantage, even though we're not necessarily going to get the tax deferred benefits from it, but it will allow for some more flexibility down the line if you need to withdraw cash for any reason. As I said, everybody's situation is different. Typically, we don't, when we see those just starting out, Roth contributions, as I mentioned, are usually where they go to, because we want to take advantage of that lower tax bracket that most young professionals exist in when they get that first job. From a tax side, Matt, I had mentioned that tax planning is more simple in this scenario, but still important. You have anything to add on that?
Oh, absolutely. I think it's definitely more simple, but it definitely can get complex pretty quick. Certainly for the 20s and 30s, there's some certain items going on in most people's lives, and it kind of changes for everybody. But a little bit of the basics, I just wanted to explain one kind of different perspective between traditional and Roth. So traditional is obviously, like you stated, the money kind of goes in, you get a tax benefit up front, gross tax free, and then when you take it out, there is tax consequences, ordinary income on that side. Whereas Roth is kind of, you'd already paid the money on the tax, you put it in, it grows tax free, but then you can take it out tax free at the end of into retirement or wherever you need to, after certainly age 59 and a half. So with that being said, that's just always something to keep in mind. I think the Roth is a very powerful tool versus a traditional, especially earlier in most people's careers. I mean, if you take a very recent grad who's got a 401k match, they're putting that money into traditional, assets and such. That's going to, grow over time, and they're taking a little bit of a tax hit now, or they're taking a little bit of a tax benefit, I should say now, but ultimately going forward, they might kind of curse themselves later. There might be some they're going to pay a lot more taxes down the road. The Roth might be a better option, maybe putting that after-tax money in, letting it grow, and then taking out tax-free at the end. Another piece of it too, just to want to speak specifically to 20s and 30s, is maybe not necessarily going through and actually doing these 401k contributions or the matches. I mean, you're potentially leaving thousands, if not tens of thousands of dollars on the table. I know sometimes maybe focusing on paying off student loans might be the bigger, something closer in the rearview mirror. In the windshield coming at you. But these different decisions do snowball over time, and we just want to be careful, because another piece of it is a lot of job hops. I mean, a lot of 401ks can be left certain places and not really connected together, and invested smartly and intelligently. So definitely want to make sure we keep track of 401ks and make sure to roll them through every time. But it kind of seems like a piece of it, Joe, I wanted to ask you, is the student loan piece and how it kind of impacts retirement contributions in the early years. Like, what are your thoughts on that?
Yeah, when I work with people who are just starting out that have got significant student loans, one of the first things they ask is, can we develop a plan to pay off the student loans? And it's absolutely important, especially with how expensive college has gotten, and how large these numbers are. But we still, if possible, we don't want to make the sacrifice of, as you said, not at least going up to the match if your employer offers some type of matching contribution, or completely neglecting the retirement dollars that you could start saving. Because you said the word snowballing, it really can make a big difference if you had a plan to pay your student loans off in 10 years after college at the complete sacrifice of not saving anything for retirement. That can cut into those long-term retirement dollars really significantly. So yeah, it's a balancing act. It absolutely is.
So the takeaway then, we want to start early and learn as much as possible. And then when it comes to actions, act intentionally, even if it is in small ways. Absorbing as much knowledge as possible and asking for help should be high priorities in this first stage. And then getting to a point where you can be a part of and participate in the long-term strategies that are available. Habits matter more than perfection. That's about it for this stage. Where we're going to now is going to be in your 40s and 50s. Some call these the builder years, upgrade years, course correction years. We're going with course correction here just for the conversation today. Mid-career is when people start to look at themselves and say, hey, I'm starting to get tired. I really want to think about retirement. I like what I'm doing, but I don't want to do it forever. I don't feel like I'm ready to retire. They start to think they're behind. Really, you're not. You're just maybe somewhere else on the map than you mean to be. And this is also where the majority of people have the most leverage in their lives as possible, while also having the most variety of variables have come into their lives, from the person next to them, somebody that you grew up with. You can be in a completely different stage of life, completely different set of circumstances. So the nuances of advice and where you should be can be completely different. But this is where our message is, you really have the most power here to be able to correct your course. And that's any kind of decision to say, hey, this is not where I am is not where I want to be. Now's the time to make those changes. And they're very possible. And
Yeah.
I think it's a good place here to jump in.
Yeah. So, Matt, this is that transitionary period where you start moving from retirement being that long-term or that so far distant idea to it's becoming more and more possible. In your 40s and 50s, you can envision a retirement. If you're lucky enough to retire in this age group, all the power to you. But most people, this is when retirement starts to get real. And this is where tax strategy, and I'm sure Matt will have more to say about this, starts to become ever more important, because you're likely near or close to, or you're already in your peak earning years. So if we re-examine the character that we started with, somebody just starting out, let's say that for the longest time, they were contributing to a Roth, they started to make a little bit more money, they phased out of that, and they start earning, let's say they're earning a comfortable wage and they're trying to max out their 401k contributions. That being, just under $25,000 if they're under the age of 50, and about 32 and a half when they're over the age of 50. There's some special conditions for those very recently in their early 60s, but we don't need to go into that now. The default that I see, at least, is a lot of people will start piling money into their traditional 401ks or IRAs. Either they've been phased out of the Roth contributions or they're really chasing that tax deduction. And it makes sense because you likely have got more things that you can work with within your tax bracket at this point. You're likely in a higher one. You might have mortgage payments, any kind of qualified medical expenses, childcare expenses, anything that's going to muddy your tax situation. So you might be looking to reduce that taxable number as much as you possibly can. It's around this time, and Ben, you said this is the course correction time, that we might start to look between alternating contributions between a traditional 401k or a Roth 401k, to see if we can work to spread that tax liability and provide the flexibility down the road. Also, during this time, if we hadn't already, we tend to try to build up the non-retirement accounts, those standard brokerage accounts that I mentioned, because as retirement nears, and we'll get to this in the next section, it's going to become a juggling act to where am I going to pull money from to reduce my taxes on a year-over-year basis. So I'm going to throw it to you, Matt, because this is, I think, where the tax strategy becomes even more critical.
I absolutely think so. And I think that the biggest takeaway for this 40 to 50 age range is ultimately in the 20s and 30s, we kind of set things up, maybe picked certain retirement accounts that made sense then, but then in the 40s and 50s, obviously, closer to peak earning, if not peak earning years, it's really going to be maxing them out or putting as much money into these buckets as you possibly can in, thinking down the road for retirement. It's really like we talked in our first episode how there's definitely a retirement crisis. And I think, in this stage, this 40 to 50 age range, it's really like when we want to start hitting a bunch of money thrust into these, retirement accounts. But also there should definitely be kind of a switch, like you were kind of mentioning, Joe. Like the Roth is kind of a much better vehicle kind of in the beginning for younger people, 20s to 30s. 40s and 50s, they might phase out, but the income might not be there. It might be different, pieces of life. It might be easier just to do a traditional 401k and max it out and get some employer match. That's definitely something to think about, specifically too for business owners. I mean, in the 40s and 50s, if you started a business younger in your 20s and 30s, you're kind of probably hitting years where business is definitely generating some more revenue and enough revenue where these different decisions matter. So, you might have started with a SEP IRA, but now it's like, the solo 401k really kind of makes more sense. We can put more money into it. Change can happen, and this is truly the course correction step, as Ben kind of mentioned. These decisions ultimately affect, the next phase we're going to talk about, phase 3, with the 60 and over in retirement, and kind of where to pull money from these different buckets, and truly how much is in each one. And there's no perfect answer for everyone, but ultimately I'd rather get the most amount of options out there and available. But this, again, 40s and 50s, I can't say this enough. This is when a lot of money's going into those buckets to fill them up and to kind of really flesh out, your investment dollars.
Yeah, and it's important to make sure that in this stage, when you are making decisions, definitely take the time to make sure that you suss out, where will this take me? What are the effects of this? Because putting the right or putting the wrong strategy into place now can really change and throw off the course that you're trying to correct. So it is very important to be heavily long-term strategy driven in this stage, but also keeping in mind that you don't have to be perfect. None of these things are irreversible. Yesterday was the best time to make the right decision, but now is the best time to make the next decision. So to go into our next stage, this is where you're preparing your ship for harbor. But retirement isn't actually where planning ends. But it does change dramatically. In this stage, we're either no longer focused on building or in a position where building isn't even happening. What we're doing now is solidifying the lifestyles we'll be carrying through the rest of our lives. And the key strategies here are around withdrawals, tax optimization, and legacy building.
Yeah, and I'll jump in and just say RMDs. That seems to be the most discussed topic when I'm talking to people who are just retired or about to retire. And RMD stands for Required Minimum Distributions. Depending upon when you were born, you may already be taking them. It could begin at 73. It could begin in 75. And those obviously could change as we move on. It used to not be so spread out. But the required minimum distributions, all those dollars that you put into the tax deferred accounts, the traditional IRAs, the traditional 401ks, the simple IRAs, SEPs, solo 401ks, anything that was pre-tax and you got that tax benefit up front, the government, once you get to a certain point, is going to want to start getting their tax dollars off of that. And a lot, and Ben, you mentioned it, this is really where the planning begins. Most people that I work with typically will retire a few years at least before they're forced to take funds out of there. And that kind of gives us a really nice window to try and maneuver some of these funds around so that when the time does come, we don't get slammed with an enormous tax bill. Because those dollars can really add up quickly, and that tax bill, that income, because that's how it's taxed, comes out as income, can start to be really high. We start looking at strategies like Roth conversions to try to front load a little bit of the taxes. The idea being taxes generally go up. We're existing in a time right now where taxes are, on a historic sense, pretty low. Mm-hmm. So the idea that 10 years from now is when you need to start taking your RMDs, there is a I can't say for certain, but there is a good chance that the income tax bracket will be a little bit higher. You're also starting to collect Social Security at this age. And even with the new tax, with the One Big Beautiful Bill, where the tagline was no tax on Social Security, as with pretty much every tax change that has ever occurred, there's never a blanket catch-all. There are stipulations to it. There are limits to it based on things like your income. Lastly, we got to start looking at Medicare premiums. Your income could affect what you're going to pay. And you might get surprised if you had been taking a little bit out each year to keep your Medicare premiums at a lower amount. But then when that RMD age comes up and you're forced to take out even more, those Medicare premiums could spike. A lot of what I do in this scenario, in this time frame for people, is work to get ahead of it, so that when that RMD age finally does come, we're not just stuck with a huge tax bill. We try to work to minimize it or at least smooth it out on a over a multi-year basis. Usually, and because at RKM, where I am, at Baldwin, where Ben and Matt are, me being on the investment side, then being on the accounting side, when we talk about some of these strategies, we will work together. That's kind of one of the benefits of the family office. Me as the financial advisor, wondering, okay, client is interested in doing potentially a Roth conversion. What are we looking at from a tax perspective? How might this hit them? So even if it's not all done at the same office, coordination between an accountant and a financial advisor is very much recommended at this stage, because taxes, as Matt is about to jump in, because I know he loves talking about taxes, becomes even more critical at this point.
Joe knows me too well. Now, there's There's a lot of good things here to kind of talk about as well. I think, Joe, you hit the nail on the head. I just wanted to kind of shout out one big thing that I think we're going to talk about again, but there's a myth of lower taxes later in life. It's super important to kind of keep that in perspective and just understand that throughout your whole life, you're paying, usually people pay in W-2 jobs, very straightforward. It's all ordinary income, taxes taken out, saving in these, traditional 401ks over time. There's maybe some Roth options too. But it gets to a certain point where you retire. There's a window there, as Joe stated, where it's kind of like the golden opportunity to maybe do some Roth conversions if you're very heavy on the traditional side, maybe to even things out a little bit, or to even optimize further. But as soon as Social Security comes into play, especially from a tax perspective, it's kind of a weird special tax situation that generates, it could be the taxability of Social Security kind of comes out of nowhere for a lot of people, especially people when they get to that age, they're kind of not expecting it, and then all of a sudden it's there. But also the RMDs is I want to say a tax bomb. It's kind of something that definitely needs to be addressed and kind of strategized before you get there. 72 to 75 is when most people take RMDs at this point, and it's something that the 10 years prior to that, really there could be some really smart tax strategies and tax moves to make sure that at that time you're not getting killed in taxes. Another piece of it too is the simplicity of accounts. Ultimately, we definitely see this a lot on the tax side. A couple might have up to 15 to 20 different accounts, but it could be multiples of similar like kind accounts. Maybe a traditional 401k and then maybe two traditional IRAs. Like they could all be rolled into one with essentially no tax consequence in most cases. And that's just something to keep maybe the paperwork a little bit more straightforward, just the less account numbers to keep track of. And it's easier to pull from different accounts if you have maybe a list of 5 or 10 versus 15 or 20. A real life scenario that kind of comes to mind is, again, retirees can often be surprised by taxes in their 70s, and we try to always talk about Roth conversions down the line, as well as maybe the last few years of working, putting money into just a checking savings account and having it sit there, and ultimately that money's already been taxed, and in retirement the next few years you have that money sitting there. You can pull from there, maybe instead of different other retirement accounts, just for those few years to make sure we're optimizing money to live off of, maybe doing some Roth conversions, but paying taxes on the least amount possible instead of trying to do everything from all different accounts at once each and every year. And that's kind of the biggest thing. Ben, I think you wanted to talk more about a few different other items too.
Yeah, Matt, I just wanted to jump in and just say, I failed to mention it, but that strategy of when we're retired and we need to start supplementing that income because we're no longer drawing it from an employer or a company that we were in charge of. Just the balancing act between if we want to take from pre-tax, if we want to take from Roth, if we want to take from taxable accounts. It's very important because at the end of the day, at least in my day-to-day, we are just working to try to minimize the big tax surprise that we might get. And sometimes it requires taking a lot from a taxable account on the front end. And sometimes it requires maybe even dipping in and maybe pulling some of those distributions from the pre-tax or the traditional IRAs or 401ks a little bit forward. Right. Because we're just seeing, we know how big this is going to be, or we have a good idea of how big this tax hit is going to be once those distributions are required to be taken out.
And the other thing too is, we're certainly, I definitely want you to always call us on the tax side to have that conversation. And then ultimately, Joe, we definitely work together on the investment and tax side to make sure that we're optimizing for all these things. So just to make sure that everybody's on the same page and it's getting the best strategy out there.
And with that strategy, you're going to see that the decisions that you made and are making really, really matter. So, and those could have been decisions that were made decades ago. So this is something to keep in mind, both, for people who are in this stage right now, but also, people who are in the younger stages, the earlier stages of career and life. The decisions that you make matter. So keeping in mind what are the consequences of what I'm deciding, and then also looking at that on the back end of, okay, I had made this decision in my youth, or as I was growing in my career, make sure that the follow through is made correctly, because depending on the original strategy that you had, the actions to be able to access cash, they will be different than maybe somebody else that you're talking to, a coworker, even your spouse, depending on when you were married. So it very much matters. And also, reiterating that help is available. Just before we wrap, finish up today, the next bit that we want to just make sure that we're talking about and reiterating are just the common traps. So Matt, there's just anything that you'd want to add about the myth of I will have a lower tax bracket when I'm older?
Yeah, no, I kind of stated a little bit earlier, but always just keep in mind that might not always be the case. It probably will not be the case. And just something to always think about, even in your 20s and 30s now, plan for the end, plan for the end in mind. Just make sure that ending is, everything you're doing is towards that ending of retirement and having a wonderful retirement.
All right, that's good. I think that it's one of those things where there's more to be said, but there's also you've also hit the nail on the head. The thing that I just want to jump in and talk about is just as much as I would love this to be true, your accountant will not always catch it. We aren't necessarily getting into an engagement to be doing an audit. We might not be in engagement where we're doing comprehensive plan for you. We're also limited by the amount of information that you give us. Even though it might be an event that's very near and dear to you, life decisions, I sold my house, or I sold my business, or something grew. We don't always know that, so we aren't always going to be able to get you into an optimized decision if we don't know, if you don't provide us all the information that's relevant. So just to keep that in mind, like, as much as we would love to say that we can catch everything and have all knowledge and all possibilities in mind at any given time, it won't be true. And we want to make sure that conversations and open communication are going to be key for you and also for us and any other advisor to help you make decisions. And that's the kind of things we like to talk about and what we love to, that's why we're in this business is to help people with these decisions and getting through. But just to keep in mind that if I don't know, I can't help. Joe, is there anything that you want to finish off with here?
Yeah, from the investment side, kind of what I like to, what I hear sometimes is I should maximize all my retirement accounts, and all retirement accounts are basically the same. I'll address the latter first. I would hope that this webinar has shown in a way that all retirements are not the same, and it is very dependent upon your specific situation, your age, your income, as to where it might be best to direct those dollars. What I'll close with is saying the max all retirement accounts before paying myself or in lieu of holding easily available cash. It's great to have a high retirement account balance. The benefits, both from a tax perspective and from just a growth perspective, are very real, that compounding over long periods of time. However, as I briefly mentioned earlier, a lot of these retirement accounts are, because they get this special tax treatment, depending upon which ones they are, they might be limited in when and how you can access them. So we talked about the standard brokerage account, or even just keeping an emergency fund. We don't want somebody to get into a situation where an unexpected bill or expense, or whatever you might call it, comes up and you have to dip into those retirement accounts. It happens. There are some hardships that are allowed, especially for things like 401ks, but they can be strict on what is allowed in that scenario. So it's just about keeping a balance between all these different types of accounts, provided you're eligible to contribute to them. Making sure you've got a good emergency savings and you're investing reasonably. It might seem like you want to jump right to the finish line and start putting tens of thousands of dollars into your 401k. But if you don't think that you can afford that right away, it's not the end of the world. Any contribution is better than nothing, and that money over long periods of time is very likely to grow. You don't have to get to the finish line right away.
Very, very good points. Just to wrap things up for today, please remember that when you're looking at life is a journey of phases and stages. We talked about, starting early, optimizing mid-career, and then structuring yourself so that you're coming into port safely, going into retirement. The right account and the right tool at the right time for the right reason, those matter more than maximizing contributions and having perfect investment timing. It's about habits, because good decisions can snowball into the best decisions. So that wraps us up for today's episode. Please join us for episode 3. Should be coming out in a matter of months here. We'll be breaking down specific investment choices and decisions that are available around retirement decision making. And we'll just leave this up here for a few minutes. Our contact information, please feel free to reach out, email us at any time. It's free. And also our phone numbers are here as well. So please keep us in mind, and thank you very much.
Real quick, Ben, sorry. I want to address Bob Tresca's question.
Oh, yeah, sure.
That he posted back at the beginning of this. How are Roth IRAs limited when you have a 401k? In short, they are not, in terms of, can you contribute to both, or can you only contribute up to you? They're completely different in terms of they're subject to their own either eligibility requirements, specifically on the Roth, and the contribution limits. They do not interact in that way.
Good. Any other closing comments, guys?
Nope, all good.
All right. Well, thank you very much, everybody, and looking forward to seeing you on the next one.
Thanks, you guys.
Thanks, everybody. Yep.